Good morning, everyone. My name is Connie Wong. On behalf of the team here at Waystone, I'd like to extend a warm welcome to all of you joining today's webinar. We are delighted to have you with us for what promised to be an insightful session focused on the latest regulatory trends and developments across multiple jurisdictions impacting fund managers in Asia. For those of you who may not be familiar with Waystone, we are the leading global provider to the asset management industry. We specialize in helping our clients navigate the complexities of regulatory compliance, offering administration and governance service to investment structures, providing market access solutions for clients who wish to market and distribute funds in Europe and Middle East. Today, I'm fortunate to be joined by a panel of compliance experts from Waystone, including Nithi Jennison, Matt Brown, Miriam Wall. They will be sharing valuable insights into some of the most pressing regulatory matters fund managers are facing today. Throughout the session, we'll be covering key topics such as UAE market access and how foreign funds can be marketed to onshore investors, the latest updates from the SFC in Hong Kong and the MAS in Singapore, and how these developments will impact your operation. And of course, we'll go into US regulatory changes, particularly some of the enhancement and also extended AML obligations for ERA and also RIA. Before we go into the discussion, a couple quick housekeeping rules. The webinar is being recorded and will be available for on-demand viewing after the event. If you have any questions throughout the session, please feel free to submit them using the Q&A function. We will address them individually after the session. So now, without further ado, let's get started. Matt, Nithi, and Miriam, thank you so much for being here today. I'll turn it over to you, Nithi, to start with the first topics around the trends and also updates in Asia.
Thank you, Connie. Hi, everyone. So for today's session on APAC regulatory trends, there are a few key areas that I've highlighted here. The first one is licensing business conduct developments. So I will be touching on both Singapore and Hong Kong as the two main jurisdictions when we go through all of these topics. The second one is AML KYC developments. What have we seen in terms of the new developments in this area in both jurisdictions? The next one is ESG sustainability developments, anything new that we should take note of. And lastly, outsourcing and third-party risk management framework and enhancements and developments. So if we go back to the first point, the licensing and business conduct developments, if I start with Singapore, last year we saw the phasing out of the registered fund manager regime, the RFMC regime, which led to certain streamlining and consolidation in the market. And I would say that we also saw, as a result, a sort of a strengthening or raising of the bar of the entry level for some of the new license applications and the applicants coming into the market. MAS did provide some updated guidelines on the licensing front. They provided more clarity on what constitutes as conflicts of interest. They provided more examples, more details. They provided the requirement to have more substantive fund management activity and what that looks like. They also elaborated on what type of fees should not be charged to the customers and what sort of disclosures that fund managers should be looking to provide. And all this type of information should be part of the license application pack. And what this means is that new players coming into the market, they definitely need to really look at their application framework, spend a lot of time, a significant amount of time, I would say, to really put together a robust application before it goes to the MAS, so as to reduce the back and forth that they will have with the MAS and address any key concerns in a very efficient manner. And then if you look at Hong Kong, I would say that they also released a quick reference guide to licensing requirements to improve the market entry-level requirements. And this was also including family offices. So from that, we also saw that Hong Kong aims to establish more than 200 family offices in Hong Kong by end of 2025. The SFC also did certain thematic inspections last year, and we saw them issuing a circular that highlighted various deficiencies in compliance with asset managers who are managing private funds and discretionary funds. I would say some of the key highlights that were introduced from the circular would be focus on conflicts of interest, how to manage those conflicts effectively, improving overall risk management framework for the fund managers, as well as risk disclosure to customers. And staying on the business development, business conduct developments topic, we also saw the SFC finalize and implement the market sounding guidelines. The market sounding guidelines provides guidance on disclosure of confidential information. It does talk about the need for market sounding guidelines in terms of the firms who are providing the market sounding, the need to make sure that consent is provided, it's documented, and the receiving end parties who should be receiving the market sounding information, how to restrict that information, how to document it, and what sort of changes they would have to make within the policies and procedures to reflect the internal controls to align with the market sounding guidelines that the SFC has introduced. So that I would say some of the key areas to focus on the first topic. The next topic is on AML and KYC developments. AML KYC has always been a trending topic. I don't think the focus for AML KYC has ever gone away. But just to highlight some key developments that we have seen, both in MAS and SFC in relation to this topic, I would say in Singapore, obviously, due to the billion-dollar money laundering case that took place, we saw the ripple effects of that. We saw the introduction of the IMC report, the AML and Other Matters Act. We also saw the MAS releasing information paper on AML CFT supervisory expectations. We also understood from some of the developments that there is a recommendation from the MAS to do an AML audit in a sufficiently independent manner to ensure that there are controls and measures put in place to identify AML-related risks within the organization. And then if we look at Hong Kong, Hong Kong SFC also, as a result of doing the thematic inspections, have identified gaps in the AML controls at the fund managers level. They have also increased the enforcement actions for failure to implement robust KYC procedures as a result of the thematic inspections that they have carried out. And I think it's interesting at this juncture to kind of highlight that you would find that there is also a Cayman AML requirement that came about due to the changes on the CBA regulatory requirement. And therefore, a lot of our clients who have a presence in Hong Kong, in Singapore, and they're using Cayman structures, we find that they increasingly are looking at how to leverage the checks and balances that they're doing in various jurisdictions to kind of complement the checks that they need to do for all three jurisdictions to comply with the regulatory requirements there. And I think that's a point to take note of when you are looking at your internal audit requirements, be it for Singapore or for Hong Kong. And then when you act as a sub-advisor for a Cayman structure, there is also a need for you to do AML KYC checks on the Cayman side. And it's important to kind of tie it all in together to see what is the best way to cover the jurisdictional requirements in all three specific countries, I would say. The next topic is ESG and sustainability developments. In Singapore, we saw the introduction of the specific ESG reporting requirements for retail fund managers to provide accurate information and to prevent greenwashing as a result. And we also saw the SFC providing a similar sort of development where the main board issuers on the Hong Kong Exchange need to report sustainability-related information on a comply or explain basis. SFC also provided some updates in terms of the management and disclosure of climate-related risks that fund managers have to carry out. So I think it's important to, again, look at how you're addressing your ESG requirements, sustainability developments in both jurisdictions. A lot of the requirements are not are mostly at the retail fund manager level and on the listing level. But I think as a fund manager, you still have to take into account some of the best practices that both jurisdictions have recommended. The last one is outsourcing and third-party risk management. So we saw the MAS in Singapore updating the outsourcing guidelines, and that resulted in a need for fund managers and for financial institutions to focus on doing more enhanced due diligence checks on the service providers, the vendors, and the employees of the vendors. And likewise, we also saw SFC conducting, as a result of doing the thematic inspection on fund managers, they have also highlighted a need for fund managers to focus on the outsourcing risks that arises from outsourcing to third-party vendors. And there is a focus from the SFC to really look at the business continuity plans and the contingency plans that you have to put in place when it comes to dealing with your current service vendors, and the need to make sure that data and customer data is protected in this outsourcing arrangement that you have with various service providers. So again, I think it's important to take a look at your policies and procedures, your controls around how you manage and manage your relationship with your outsourced vendors, and whether the checks and balances are sufficient and enough to comply with the regulatory requirements. I think with that, I will pass on to the next speaker. That would be, I think, Matt from the UAE side.
Thank you very much, Niti. Thank you very much for everyone for taking the time. I think from a regulatory trend perspective here in the UAE, there are many topics that I could cover. I've noted down some here, which is the continued focus on anti-money laundering and proliferation financing by the Free Zone and the federal regulators, licensing trends in the DIFC, the ADGM, from the central bank, the Securities and Commodities Authority, and VARA. Enhancements we're seeing from a regulatory perspective in the digital asset ecosystem, developments from brokerage perspective, both institutional and retail, cybersecurity, data protection, and outsourcing and third-party risk management. Obviously, a lot to cover in the time allotted, so I'll try and cover as much as I can. Focusing on anti-money laundering and proliferation financing by the Free Zone and federal regulators, the DFSA is in 25 and 26 will continue to review AML returns and annual information returns for all entities, but they will have a specific focus on DNF BPs. And they will monitor targeted financial sanctions compliance and suspicious activity reporting. Alongside, they're going to continue to monitor unlicensed activities to maintain compliance with the relevant federal and local rules and regulations. Previously, unlicensed activities such as real estate, commodities, and other activities were not included, but now they certainly are. Looking ahead, the DFSA's AML strategy will centre on audit obligations to strengthen the AML audit requirements. There will be a scrutiny of firms' AML frameworks and the preparation of FATF mutual evaluation in 2026. The UAE came off the grey list for FATF in 2024, so they're very much implementing what was declared by the UAE, and looking forward to that mutual evaluation in next year in 2026. The National Risk Assessment for Proliferation Financing This was an assessment to identify risk factors, gaps, and challenges, as well as helping the authorities implement effective mitigation strategies to combat proliferation financing. The most recent assessment was in 2019, although the current assessment is in progress. And there will be an emphasis for the need of firms to integrate proliferation financing into their customer due diligence and enhance due diligence procedures, referencing their customer due diligence questionnaire. Cybersecurity is also very much a hot topic here in the UAE. The UAE regulators have highlighted this as a priority supervisory area for them. I mean, the main areas they're focusing on cyber governance, the responsibility of cyber risk and how it's managed, similar to any other risk, hygiene, phishing campaigns, antivirus, firewalls, and resilience controls such as multi-factor authentication for passwords. The DFSA in February 2024 requested firms to submit their responses to a questionnaire on cybersecurity practices and compared the results with the outcome of the 2020 review. The results of this questionnaire were shared with firms at the end of November last year. From the FSRA and the ADGM, they issued IT management guidelines which are embedded into the rule books. The guidance comprised 4 sections that identify best practices for IT risk management, and they should consider adopting the establishment of a culture of effective IT risk management, managing such an IT environment, interacting securely, and leveraging business embedded technologies. Just last month, there was a very large hack of a crypto exchange here in the UAE, very much in the press, and I think that will continue the regulators' focus on such issues in 2025 and beyond. The digital asset ecosystem is continued to see a significant increase here in the UAE from both digital asset investors and virtual asset fintech groups as they establish themselves in the region. The regulators continue to develop and refine regulatory regimes to accommodate new and existing models. For example, the central bank are expected to release a digital dirham framework and connectivity to other international banks for efficiencies in cross-border payments. Fiat reference tokens have increased in issuance and utilization, especially in cross-border payments to corporate entities. The 2 financial free zones, the DIFC and the ADGM, have recently increased their scope of coins able to be traded, custodied, and issued. And the Securities and Commodities Authority are now accepting applications for licensing as a virtual asset service provider in mainland UAE. I would say that all the regulators in the region have a particular focus on technology and systems when applying for such licenses, and the increased focus in anti-money laundering is prevalent in such review for virtual asset service providers and fintech companies. Licensing trends, speed to market. So the financial free zone regulators have had an increase of staff and streamlining of applications to get applicants to market quickly. Hedge funds have definitely landed here in the UAE. I think initial entrants were established multi-strat groups, although this has developed into single name hedge funds and startups within this new ecosystem. On outsourcing, regulators are open to outsourcing of key control functions and continue to do so, giving new and emerging entrants the ability to engage with experienced third parties, giving that speed to market and time to search and appoint full-time individuals. Operational due diligence and oversight of third-party providers is an increasing focus of the regulators, and it feeds into my previous comments around AML, proliferation, financing, and cybersecurity. There have been some particular developments around UAE market access and promotion of foreign funds. There were rules implemented by the Securities and Commodities Authority on the promotion of investment funds in 2023, but they were implemented in April 2024. This effectively prohibits the promotion of foreign funds to retail investors. So you would have previously been able to distribute mutual funds and alternative asset funds to both retail and professional investors. Subsequently to April 2024, you can no longer distribute such mutual funds to retail investors in mainland UAE, and you would need to utilize either a free zone fund, which has been passported to mainland UAE, or a UAE domiciled investment fund. Similarly, for promotion of foreign funds to professional investors, this is now had the exemptions removed. So you previously didn't have to register the fund, and you previously didn't have to utilize a local promoter. Post April 2024, you will now have to register such funds with the Securities and Commodities Authority and utilize a local promoter as part of your distribution framework. The penalty regime for distribution of professional funds is still to be released, but it is also a commercial risk. We have seen some allocators in the region looking for contracts to be rescinded on the basis of marketing not having happened through a local intermediary. I will take a pause there. Miriam, maybe if I can hand over to yourself to cover the United States.
Thank you, Matt. Hi, everyone. My name is Miriam Wool. I'm an executive director here at Waystone, based in New York. Today, we're going to talk through some of the top considerations for Asian managers with a US presence for consideration this year. There are really 4 trends that we're going to focus on today. So that will be the 2025 SEC exam priorities. We'll talk about some of the AML and CFTC compliance enhancements, including the Corporate Transparency Act and the FinCEN's rule. We'll talk about the importance of cybersecurity and incident response. And then finally, we'll touch briefly on the importance of outsourcing and third-party risk management. So if I look at the 4 headline items for this year, every year the SEC publishes a list of their examination priorities. On the list for examination priorities this year in 2025, we expect regulatory exams to continue to focus on some of the common themes, such as the effectiveness of advisors' compliance programs in the core areas such as marketing, valuation, and trading. We will see continued focus on new SEC registrants. So, for example, one of the items highlighted in recent exams by the SEC has been the use of off-the-shelf compliance manuals that were not tailored for consistency with advisors' operations and their business lines. We'll go into some further detail on the SEC's examination priorities during this session. The next item we'll cover then is some of the enhancements in the AML and CFT compliance framework. We've had a new rule from FinCEN due to be implemented in January of 2026. So we're 10 months out from that rule, and the industry is preparing for compliance with that. And then we also have the latest debacle for the Corporate Transparency Act, which will affect entities here in the US and foreign entities with a presence in the US. The current date for compliance with that rule is the 21st of March 2025. However, there are some ongoing litigation here in the US, and we do expect that to continue. Finally, we'll talk about cybersecurity preparedness. That's been a common theme in all regulatory jurisdictions over the last number of years. Just last week, the SEC announced a new cyber and emerging technologies unit for the benefit in particular of retail investors. So let's dive in. First, I'll go to the SEC exam priorities. So as with previous years, the SEC will continue to prioritize examination of advisors that have never been examined and those that have been recently examined, with a continued focus on newly registered investment advisors. So the first thing is advisors who have never been examined may reasonably expect to receive a visit this year, and newly registered investment advisors, so those that have been registered within the last 18 to 24 months, can expect reasonably to get a visit this year. The 2025 examination priorities do include some of the common themes that we've seen in previous years. So that would be fiduciary duties, standards of conduct, navigating the effectiveness of advisors' compliance programs, and focus on some of the core areas then, such as marketing, valuation, trading, and custody, as well as compliance with some recently implemented regulations. Areas such as artificial intelligence, cybersecurity, and crypto assets are top of mind for exams, as well as areas that have been the targets of recent SEC rulemaking activities. So there we're talking about private funds, in particular fees and expenses charged at the private fund level, and also the outsourcing of any investment related functions. I think I mentioned there's for sure a focus on the use of off-the-shelf compliance manuals. The SEC has commented on some of their recent examination findings that they found a number of compliance manuals at newly registered investment advisors were not tailored, were not fit for purpose, and some disclosures were not quite accurate in line with the advisor's operations and business lines. So certainly food for thought there if you're a new registrant. I would say focus on updating your compliance manual and perhaps expect a visit this year. When we turn to registered investment advisors, advisors to private funds remain a very significant portion of the SEC's registered investment advisor population. The SEC's Division of Exams will continue to focus on advisors to private funds. They have stated that very clearly, and they will prioritize topics such as the following. So whether or not disclosures are consistent with the actual practices, and if an advisor has met its fiduciary obligations in times of market volatility, and whether a private fund is exposed to interest rate fluctuations. So examples of investment strategies that may be sensitive to market volatility and/or interest rate changes can include commercial real estate, illiquid assets, and private credit. So the division has said they may particularly focus on examinations of private fund advisors that are experiencing poor performance and/or significant withdrawals. They will also focus on those that hold more leverage or difficult to value assets. So commercial real estate, liquid assets, illiquid assets, and private credit are a core focus for the registered investment advisory community. The SEC has also commented that they expect to focus on the accuracy of calculations and allocations of private fund fees and expenses, and that's both at the fund level and the investment level. So examples of areas that may impact the accuracy of fee calculations would include the valuation of illiquid assets and the calculation of post-commitment period management fees. Another item of focus for the SEC examinations is disclosures of conflicts of interest as well as risks. In addition, the adequacy of the policies and procedures around those disclosures of conflicts of interest and risk. So some examples of some products or practices for the focus of such conflicts, controls, and risks and reviews would include, one, the use of debt, including fund level lines of credit, advisor-led secondary transactions or transactions between funds, two, investments held by multiple funds, which is quite common in the private debt and private credit world, and then three, the use of affiliated service providers, so group and affiliated service providers. And finally, there will be a focus on recently adopted rules that will include amendments to the Form PF, which affects registered investment advisors, and any updated rules that govern investment advisor marketing. The SEC does wish to assess whether advisors have established adequate policies and procedures and whether their actual practices then conform to those policies and procedures. So they're the headlines for SEC examination priorities. Do reach out if you wish to discuss more. I'll move then on to some of the AML changes. So we have a Corporate Transparency Act here in the US and a new deadline this year. There's been some back and forth regarding the Corporate Transparency Act. So what is the rule? First and foremost, the Corporate Transparency Act requires certain entities known as reporting companies to report beneficial ownership information to the Financial Crimes Enforcement Network, known as FinCEN. And that will include details about individuals with significant control or ownership of 25% or more of an entity. So this signifies a shift to align with some other international jurisdictions where we already have reporting obligations around ultimate beneficial ownership, such as Ireland and Luxembourg. The Corporate Transparency Act originally went into effect on the 1st of January 2024. There has been some activity in the Supreme Court. Most recently, just last week here in the US, there was a suspension of that rule issued in December. Then that suspension was lifted last year, just at the start of this year. So we do expect to see more on this rule, but for now, it would appear that rule will be implemented. So who's in scope? The Corporate Transparency Act affects most corporations, LLCs, and partnerships that are formed or registered to do business in the United States. So the Corporate Transparency Act does have 23 exemptions, so that may exempt an entity from having to file the beneficial ownership report. And it's very important to carefully review each exemption for its technical qualifying requirements. Registered investment advisors are out of scope for the rule, but the exemption does not cover state registered advisors or exempt reporting advisors, which may include foreign advisors. So conscious that many of you listening in today may be filing as an exempt reporting advisor in the US, you may be in scope for the Corporate Transparency Act, if so. So some of the exemptions worth noting: registered investment advisors, as I noted, pooled investment vehicles, so most domestic US funds, foreign pooled investment vehicles are covered if they're registered in the US with some very limited disclosure requirements, and subsidiaries. So that includes entities that are wholly owned by an SEC registered investment advisor. They would still be exempt. So deadlines for now: most reporting companies must file their reports by March 21st, 2025. The reporting requirements really focus around identifying the individual who does own more than 25% of the company. No filing is needed to rely on exemptions, but it is important to document the facts and circumstances if you are relying on an exemption. And so what do you need to file if you are in scope? The reporting requirements around each beneficial owner include the name, address, date of birth, an identification number, and then documentation to substantiate that. So more to come on that. Keep an eye on the Waystone website. We'll be updating the industry as that develops. And then the next AML rule that we're preparing for here in the US is the FinCEN's AML update. So the Financial Crimes Enforcement Network, or FinCEN, issued a rule regarding AML requirements for US registered investment advisors. That rule comes into effect on the 1st of January 2026, and it establishes minimum standards for AML programs for advisors. Among other things, the final rule prescribes some minimum standards for AML and countering the financing of terrorism, and it requires programs to be established by certain registered investment advisors, and it also demands the reporting of suspicious activity to the FinCEN. So that is a new development in the AML landscape here in the US. In some other jurisdictions globally, we've already had the implementation of reporting suspicious activity. This would be a new requirement under the FinCEN rule. So who does the rule apply to? The final rule applies to registered investment advisors and also to exempt reporting advisors. So investment advisors that are reporting information to the SEC as exempt, but are not fully registered under the SEC's regime. I would say there's one important item to note for Asian-based managers. Investment advisors with their principal office and place of business outside of the US are only required to comply with the final rule with respect to their activities that take place within the United States, including through the involvement of US personnel at the investment advisor, or that provide services to US persons or foreign located private funds if the investor is a US person. So important to look at the facts and circumstances if you're a foreign advisor to determine whether or not you're in scope. So some of the key considerations, again, referencing the fact that you will have to consider reporting suspicious activity to the FinCEN and developing a very robust compliance program around your AML and CFTC compliance. That's the key consideration there. I would say the industry is preparing now. We have about 10 months from the deadline to prepare. So again, would reach out for any assistance in that regard. And finally, we'll touch on our favorite topic, which is cybersecurity. I think that's, again, a common thread across many of the jurisdictions that we operate today. So on February 20th, the SEC announced the creation of a Cyber and Emerging Technologies Unit known as C2, and that will focus on combating cyber-related misconduct with the aim of protecting retail investors from bad actors in the emerging technology space. So very specifically, the C2 will utilise the SEC staff's substantial fintech and cyber-related experience to combat misconduct, and it will focus on securities transactions in the following priority area. So number one, fraud committed using emerging technologies such as artificial intelligence and machine learning. Number two, the use of social media, the dark web, or false websites to perpetrate fraud. Number three, hacking to obtain material non-public information. Number four, takeovers of retail brokerage accounts. Number five, fraud involving blockchain technology and crypto assets. Number six, regulated entities' compliance with cybersecurity rules and regulations. And finally, the seventh item is public issuer fraud and disclosure relating to cybersecurity. So in February of 2022, the SEC had issued a cybersecurity rule which affected registered investment advisors, but that rule has not yet been finalised. So we expect the announcement of this Cyber and Emerging Technologies Unit and the SEC's continued focus on cybersecurity to bring about some positive safeguards for retail investors in particular. We expect to see this being a core area of focus for registered investment advisor examinations as we look into 2025 and beyond. Thank you very much. Please do reach out with any questions or comments.
Thank you, Nithi, Matt, and Miriam for sharing your insights on regulatory trends and developments. I see that many managers attending today, they operate in multiple markets. So I hope you found the session valuable as we covered the key financial markets most relevant to fund managers in Asia. We will be sharing the materials after this session. And if you have any questions, we have included here, our contact email, and we'll be also sharing a slides over. If you come across anything, do feel free to reach out. So thanks again for joining us today, and have a good day. Thank you.